the Resilient Advisor Podcast, the show for high-performing financial advisors. We bring you the best practices of the industry's top performers so that you can build resilience in your business and your personal life.
Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter, and joining me for this episode is J.R. Rieger. J.R. works for S&P Dow Jones Indices as the global head of fixed income indices. He is an author, a speaker, and a fixed income expert. J.R. has been working in the business since January of 1987, which gives him a unique eye with a long view on these fixed income markets. James, thanks so much for joining me.
Well, it's a pleasure to be here, Jay.
All right, so we could go a lot of different directions with this podcast. I have a couple of ideas that advisors keep bringing up in my consulting interactions. And the first is around this idea of active versus passive as it relates to fixed income. I know you're an authority on this subject. What are your thoughts?
Well, Jay, growing up in the bond business, I always viewed passive versus active discussion as a kind of a crazy discussion because the portfolio managers are the best. They've got the best traders, the best analysts, the best access to data, the best tools to analyze the data. And so they should be able to perform better than a dumb index. But the facts are it's quite the opposite. When you look back and take a step back and look at the challenges of investing in the fixed income space in regards to timing, credit selection, interest rate views, all of that plays a role in whether the portfolio manager is going to match the index performance or beat it. And then the real question comes in, can they do it again the next year? So when you look at the SPIVA report, a report that we publish, which shows S&P's index versus active data, it shows that institutions that run corporate bonds, for example, don't necessarily outperform the index. And the last year that we tracked, it's about 30% of those funds did not beat, only 30% beat the index. So it's a very, very challenging aspect to look at passive versus active and decide who your manager is going to be from the perspective of alpha versus the marketplace.
You know, I'm very familiar with that SPIVA report, especially as it relates to equity managers and using that for comparison. But do you have any insight as to that 30% number over a historical view? Each year, does it generally seem to be about 30%? And then does that number go down when you're looking at rolling 3- and 5-year numbers in the fixed income space?
Well, it does change, and that's what's interesting about the report, because in some markets you would expect that the bond managers should be able to beat the index, and particularly in volatile times, right? Because they have the bird's eye view on the markets. So in some markets they do outperform the index, and in other cases they lag the index in performance. So it depends on the time period, and it does change. We have to be very upfront with everybody that the market dynamics do create opportunities for portfolio managers to outperform an index, and cases where those markets create a very difficult challenge for them to beat an index. The question I have in my mind is, if they beat the index one year, can they do it the next? And that's one of the issues that we have with manager selection, right? So how many times can they outperform the index in sequence year after year? And that can change dramatically.
In the Wild West of middle market debt, do you feel there's an advantage to having an active manager in that space as opposed to indices, or do you have any data that contradicts that?
Well, credit selection is definitely something that needs to be reviewed in this particular time period, as we have a particularly volatile equity markets, and on the high yield side of things, high yields tend to move in more correlation to the equity markets. And I think you're referring to EM markets, Jay?
Actually, middle market here in the U.S., so smaller and middle market companies that, there are a handful of mutual funds out there and active managers in the SMA space who are saying they can deliver alpha through the selection process in that market because it's a little bit more of the Wild West.
Yeah, and it can be. The questions in regards to that, not only credit selection, but depth of liquidity. So if you're looking at smaller credits, can you get in and out when you want to versus the incremental return you may be getting out of that investment? And that's a big question yet to be proven in the bond markets. So what we've done is we're tracking the larger issuers versus the broader pool of debt that's available in the marketplace. And we're finding that the larger issuers are outperforming relative to the smaller issues. So when we're talking about credit selection in regards to earning alpha, it's very important that the right bonds are chosen at the right time and that they have the liquidity or depth of liquidity to be able to get out of those bonds when you want to.
Excellent. So let's put this into application for a financial advisor. They're constructing portfolios for their clients, and they have several options. One, they could try and find bonds from their bond desk. And now, today, most firms, as you know, are drying up that liquidity for one reason or another. They could use an actively managed bond fund, or they could go out and use exchange-traded funds that are based on these ETFs. In today's market, could you speak to the risks and benefits of all three of those options?
Yeah, when we're looking at individual bonds, there's a friction, a cost, if you will, that's not necessarily disclosed in buying and selling individual bonds for individuals. That cost rises the smaller the bond position is. So I call it the hidden cost because it's definitely a friction. I publish a piece on this. It's called The Hidden Cost of Retail Transactions, and we compare two asset classes, munis and corporates. In that piece, munis are much more costly in regards to that hidden friction, if you will, the mark down friction that occurs, but it also is in place in the investment grade corporate bond world as well. It's not as big a hit, but in this low rate environment, those markups erode returns, and it makes those individual purchases or sales of bonds a very costly transaction, inefficient, if you will. Mutual funds would be much more efficient exposure into the broader markets. However, they're not the in and out tactical place necessarily to be because of the end of day restrictions on marking those funds. And ETFs would be the much more efficient way, lower cost exposure. And when you look at ETFs versus individual bonds, it's much more efficient based on the low cost of transaction, very much like an equity. ETFs have been a driving tool in the bond markets, changing the way the bond markets are behaving and investors tactically approach fixed income.
What are your thoughts on ETFs with specific maturity dates? And then to take it a step further, what are your thoughts on laddering those in a portfolio?
Yeah, I think the ETFs that have launched maturity date-based fixed income products have taken the view that the individual bond buying and selling from a laddering perspective is very inefficient and costly. So we work with institutions to create the underlying indices for those ETFs, just being upfront with everybody. But the goal of those products, those indices, is simply to create a bond-like product that is not one bond, but a diversified portfolio of bonds that mature in each year that act like a bond. So they have the characteristics of a bond that matures in each year. That gives you exposure to a broad set of bonds, not just one bond, and the ability to get in and out without any concerns about liquidity. When you're laddering a portfolio, Jay, you've got to try to find the bonds that, one, meet your credit criteria and quality criteria, and two, meet your ladder needs, whatever the rung of the ladder you're trying to fill. That can be very difficult and, of course, costly to do, and that erodes your return, and that defeats the purpose of the ladder. So the ETFs that have launched, and there's a number of them, create a much more efficient way to supplement your ladder or build a ladder.
And are you finding that using them as a supplement as opposed to a standalone tool for building ladders is an effective way for advisors to operate in this rate environment?
Jay, I travel the country and talk to advisors, and I find that in those conversations, they often are using individual bonds in their ladders, and when they can't find a bond that fits the needed rung of a ladder, that they've been using ETFs that are designed to do that in the place of trying to find that bond. And then if they ever find the bond later, they replace the ETF with the bond issue. But that's the kind of conversation I've had across the U.S. with advisors in regards to laddering.
Excellent. And one more question on using those specific types of ETFs for constructing a ladder. I get a lot of questions about what happens in the final 18 months of an ETF that is maturing. Could you speak to the mechanics of that and how advisors should use that in a portfolio?
Well, I can speak to the index. I can't speak to the ETFs, but they match the index pretty closely. The bonds never leave the index unless they no longer qualify for other criteria other than maturity. But the goal is to keep them in the index until they actually mature out and the entire index becomes cash at when the last bond matures. That design is intentional. It's because we want that basket of bonds or that diversified basket of bonds to act in concert like one bond. So the narrower we can make the maturity range, the better. And that does leave some cash in the fund or the index, but it leaves the cash in for only a nominal period of time so that it can be redeployed upon the final maturity of the final bond.
So without giving specific allocation advice, it sounds like it might be best to have that first year in your ladder maybe not be an ETF, or as the ETF gets to the maturity year, roll out into something that you're going to get a little bit more yield for the risk in that year. Is that a fair statement?
Well, I think that if you're, the risk of holding an individual bond, the market risk, interest rate risk is taken off the table if you're going to hold it to maturity. And that often is a big if. And I do a lot of public speaking around the world, actually, and we talk about this one concept, the concept of I'm going to buy that bond and hold it to maturity. Well, guess what? Life happens, right? So there's all kinds of other needs for that bond, and often you have to sell that bond well before you desire to sell it. So if you're building a ladder and you're going to hold it to maturity, I would say you're right, Jay. That's probably a good way to go.
Excellent. Let's shift gears. If an advisor feels that we are in a rising rate environment, let's talk about the types of bonds that make the most sense. What are your thoughts?
Well, there's first of all, in this marketplace, I read the same papers everybody else reads, and I listen to the forecasters, and I scratch my head and say, how the hell do they know this? Right? Nobody's ever seen this market before. This is a very unique market, and while we're seeing some volatility on the equity side, and we are seeing some pressure on yields, we can look at this from the perspective of, do you think the long end is going to go up more or not? And there's pressures on both sides of that yield curve, right? There's a negative yield environment still in the $7.5 trillion mark globally, which puts pressure on the long end of the curve, plus all the other stuff going on, the global geopolitical risks and all that. And then you've got inflation rearing its ugly head, and you've got the weakening dollar. So all those forces on the yield curve, both pushing up and pushing down on it. So I don't make projections, but there's a lot of good reason to think that the yield curve is going to be flatter for a bit longer. But if you think the yield curve's going up, there are products to look at. Of course, there's duration management. There's floating rate asset classes that move up as certain benchmarks move up, which are valuable in a rising rate environment. And then there's asset classes that are rich and relatively cheap versus each other. And I'm just going to call it right out. High yield corporates in this market where the credit spreads are so damn tight, one has to worry whether you're getting compensated for that asset class. But in certain investment-grade asset classes, like Munis, they're shorter duration. You're getting a good tax-free coupon, and after the 37% tax rate, you are earning more than you would on a corporate bond. So there are opportunities still in the fixed income space. Some things to look at relative to each other include that kind of comparison.
So ballpark in terms of credit, how far down do you need to go in munis to get that advantage over high yield in corporates?
Oh, to get the high yield in corporates right now, you've got to go into the triple B segment of the high yield of the muni marketplace, which includes a lot of revenue bonds, like healthcare bonds and housing bonds, to get to that kind of yield on the high yield side. But to get just to get exposure in the fixed income markets relative to investment grade corporates, munis are from a taxable equivalent yield perspective 30 or 40 basis points cheaper than investment grade corporates and 3 years shorter duration. So it is a no-brainer kind of comparison. One is historically cheap relative to the other.
Yeah, 40 basis points with rates where they are is an absolute no-brainer. So with that in mind and thinking about this in terms of execution for the financial advisors, we're back to the adage of, do you buy the individual muni bonds, do you buy the mutual fund, or the index? Could we speak specifically, because I'm sure some of the same dynamics and rationale are there, but on some of the optimal ways you've seen advisors leveraged index products in the muni space?
Yeah, so one of the things to worry about, Jay, is liquidity. There's a reason why munis are cheaper than corporates, and it is liquidity. They are harder to buy, harder to sell, and as a result, markets require a liquidity premium. So that said, if you can access bonds individually and know that they're going to be a buy and hold, and know that you don't need to sell them again, and know you're getting a fair price. All those are questionable no's, right? So, you can buy individual bonds if you're solid about all that. Or a more efficient way to go is with an exchange-traded fund in these markets, because you can get in and out whenever you want. There is no liquidity risk. There is no transaction friction relative to buying individual bonds, and because the ETFs are buying bonds in size, and you can't, size being 1 million bonds or more, so they're much more efficient relative to individual bonds, and there's a number of ETFs that have quite a bit of assets under management and secondary market trading of the shares. So there is a depth of liquidity that can be reviewed. It's all public data to gain confidence that is the right path for you to take.
Excellent. Last question for you, JR. In this potential rising rate environment, the question usually comes up of whether somebody should look at some floating rate securities in their portfolio or allocation to tips, or both. Could you provide some color on that?
Well, floating rates really dragged in 2017 when we the markets thought that rates were going to go up. They really didn't. Now that we're in a period of volatility and seeing some yield return back into the 5, 7, 10-year marks, we are seeing that floating rate asset classes like floating rate treasury and floating rate corporates are beginning to earn their position in decision making for investors. And then on the high yield side, the floating rate senior loan market kind of got beat up in 2017 because there wasn't a rising rate environment. And now that we are in one, that's showing its characteristics are very strong in this market, with the holding in very much earning its coupon so far this year, while not seeing any price depreciation, when all the fixed rate asset classes and the equity market have taken a beating.
Okay, and what are your thoughts on tips?
Well, tips are showing a break-even rate of about 2.10, 2.1%. It depends on your inflation expectations. So we have to be a little bit careful there. If you think inflation is going to be higher, you've got a break-even rate of about 2.1. So if you think it's going to be higher, tips can be attractive. If you think inflation is being overstated and worries are overblown, then tips could be rich.
Excellent. JR, it's been great having you on the podcast. You're a wealth of knowledge. How could listeners find out more information about S&P Dow Jones Indices and your work?
Well, our free access website is www.spindices.com, and that provides you with a tremendous resource, both educational materials and data to be put to work.
Excellent. JR, thanks so much for coming on the podcast.
Thank you, Jay.